The foundation of global finance is shifting beneath our feet in ways that demand immediate attention from every serious observer of monetary history. For decades, the architecture of international settlements rested on a single currency's dominance, yet recent legislative moves by major resource exporting nations signal that this arrangement faces structural pressure far deeper than temporary policy disputes. What emerges is not merely a technical adjustment in payment rails, but a fundamental re-examination of how value crosses borders when traditional channels tighten, and that re-examination carries profound consequences for hard assets that have outlasted every fiat experiment. Consider the quiet passage of comprehensive digital asset legislation in a nation that remains one of the world's largest producers of energy, industrial metals, and agricultural commodities. The statute runs nearly 300 pages and establishes a formal framework allowing enterprises engaged in cross-border commerce to settle contracts denominated in digital tokens. Transaction size faces no statutory ceiling. Settlement may occur directly between counterparties without intermediation by institutions that historically sit at the center of dollar clearing networks. Reporting and tax obligations remain, yet the operational freedom is real. The measure takes effect in early autumn, coinciding precisely with the formal rollout of a state-issued digital currency that banks and larger commercial entities will be required to support. This dual development is best understood against the background of correspondent banking. In the conventional sequence of trade finance, payment instructions travel through a chain of institutions, many of which maintain accounts denominated in the dominant reserve currency. Control over those accounts confers the practical ability to interrupt settlement. When access to such chains narrows, a resource-rich economy retains physical goods that the world continues to demand, yet struggles to convert those goods into freely usable purchasing power. Digital tokens that function as bearer instruments offer a parallel pathway that does not require the same institutional permissions. The legislation therefore serves first and foremost as an instrument of commercial continuity rather than a broad invitation for domestic speculation. Ordinary citizens inside that economy face tightly constrained participation. Annual acquisition limits hover near the equivalent of a few $1,000s. Suitability assessments and pre-approved asset lists further restrict access. Domestic use for everyday purchases remains prohibited, and advertising of acceptance is disallowed. These restrictions reveal that the statute was never designed as a vehicle for household savings protection against currency depreciation. Capital control considerations certainly play a role, yet the more decisive motive appears to be the simultaneous introduction of a central bank digital currency whose ledger remains fully visible to monetary authorities. Large banks must begin offering the digital unit immediately. Businesses above defined revenue thresholds follow in stages. Universal acceptance every a few years. Adoption incentives include fee structures paid by the central bank to commercial lenders for routing salary payments through the new system. An explicit effort to generate demand that organic preference has so far failed to produce. The timing is not accidental. Parallel regulatory efforts in the largest economy are advancing frameworks that would permit regulated institutions to issue digital representations of the reserve currency, fully backed by sovereign debt instruments. Once those instruments become widely available through ordinary mobile devices, residents of any jurisdiction with internet access could hold claims on that debt without relying on local banking intermediaries. For authorities seeking to preserve domestic monetary sovereignty, the prospect of widespread substitution toward an externally issued digital unit represents a structural challenge that cannot be blocked by physical borders. Preemptive construction of a controlled digital alternative, combined with limited permission for external digital settlement, constitutes a defensive perimeter. From the vantage point of precious metals, markets the implications unfold across several layers. First, any durable fragmentation of settlement systems tends to elevate the relative attractiveness of assets that require no counterparty for finality. Physical gold and silver settle by delivery. They carry no credit risk of an intermediary and no dependence on a particular clearing network. Historical episodes of reserve currency contestation, from the gradual displacement of sterling after the First World War to the more recent accumulation of gold by central banks outside the traditional Western sphere, demonstrate that official and private demand for bullion expands when confidence in the permanence of existing payment hierarchies weakens. The current legislative moves reinforce that pattern. Second, the resource profile of the jurisdiction in question matters. Persistent export capacity in energy and industrial metals generates ongoing foreign exchange inflows even under constrained settlement conditions. When those inflows increasingly arrive in forms other than the traditional reserve currency, recipient monetary authorities and commercial entities face decisions about how to store the resulting surplus. Diversification into gold has already been visible in official reserve data for several years. Continued friction in conventional channels is likely to sustain or accelerate that diversification. Silver, with its dual monetary and industrial character, benefits from both the monetary premium that accompanies systemic uncertainty and the physical demand tied to energy transition and electronics manufacturing that remains robust regardless of payment system architecture. Third, the competitive landscape of digital money itself introduces second-order effects. Multiple jurisdictions are advancing distinct models. Some emphasize corporate issuance of dollar-linked tokens. Others prioritize state-controlled ledgers. Still others explore baskets that incorporate precious metals or commodities. Each model seeks influence over the emerging rails of value transfer. In an environment of competing standards, the residual demand for a neutral, non-state store of value tends to rise. Gold has performed that function across centuries of monetary experimentation precisely because it is no one's liability. Silver has alternated between monetary and industrial roles, yet retains sufficient monetary memory to respond to the same pressures. Market participants should therefore distinguish carefully between short-term price narratives and structural positioning. Claims that any single legislative act will propel a particular digital asset to predetermined price targets overlook the actual design of the statute, which caps domestic investment demand and treats tokens primarily as a settlement medium rather than a reserve asset. Settlement demand does not automatically translate into net accumulation. Tokens can enter and exit the jurisdiction without residual holdings. By contrast, official and private accumulation of physical metal leaves a lasting imprint on available above-ground stocks. The distinction is material for anyone allocating capital with multi-year horizons. Looking further ahead, the evolution of payment systems is unlikely to produce a clean replacement of one dominant currency by another. More probable is a multipolar arrangement in which different corridors rely on different instruments, some digital, some traditional, some hybrid. In such an environment, the opportunity cost of holding non-yielding monetary metals declines relative to the risk of concentration in any single national unit. Central bank purchasing patterns already reflect this calculus. Private investors who monitor those patterns gain an informational edge. Mining equities, streamers, and physical holdings each offer distinct risk-return profiles, yet all are levered to the same underlying monetary uncertainty. Historical precedent offers additional perspective. When sterling's reserve status eroded, the process was gradual, punctuated by discrete crises, and accompanied by rising official gold holdings among emerging powers. When the dollar's share of global reserves has fluctuated in recent decades, gold's share has moved inversely. The current episode differs in the speed of technological change and the explicit construction of alternative digital rails, yet the underlying incentive, preservation of monetary autonomy, remains constant. Nations that produce real resources and face restricted access to conventional finance have rational reasons to experiment with parallel systems. Those experiments, whatever their ultimate success, enlarge the opportunity set for assets that sit outside any single system. For the professional observer of gold and silver markets, the analytical task is therefore to track three parallel developments. First, the pace at which digital settlement frameworks gain commercial traction among resource exporters. Second, the response of official reserve managers as those frameworks mature. Third, the behavior of private capital as confidence in the permanence of existing hierarchies is tested. None of these developments requires dramatic predictions. Each is measurable through trade data, reserve statistics, and futures market positioning. The combination, however, points toward a secular rather than cyclical support for monetary metals. In practical terms, portfolio construction benefits from explicit recognition that monetary regimes are not static, allocation frameworks that treat the current reserve arrangement as permanent risk, awaiting the insurance characteristics of gold and silver. Conversely, frameworks that treat every geopolitical friction as an immediate catalyst for parabolic price moves risk over trading noise. The measured approach monitors legislative and technological milestones, calibrates exposure accordingly, and maintains liquidity sufficient to respond when structural shifts become more widely recognized. The autumn implementation timeline for both the digital asset statute and the state digital currency will provide early empirical evidence. Transaction volumes in permitted digital settlements, adoption rates of the domestic digital unit, and any measurable diversion of trade flows away from traditional clearing centers will all be observable. Parallel regulatory progress elsewhere will determine whether the defensive perimeter under construction faces a genuine external challenge or remains largely precautionary. Either outcome carries information value for metals markets. Ultimately, the story is less about any single statute and more about the persistent human preference for final settlement in assets that cannot be unilaterally restricted. Gold and silver have satisfied that preference across empires, wars, and technological revolutions. The present episode of payment system experimentation simply reaffirms their utility. Market participants who internalize that continuity rather than chase ephemeral narratives position themselves to navigate the multipolar monetary landscape that is already